All right, let's dive right into this. Welcome to The Explainer. Today we're going to look at the mid-August fintech earnings season through a slightly different lens. We're going to look at these massive corporate maneuvers, exactly like an NBA front office restructuring a roster right before training camp. We've got one veteran stockpiling capital like it's a preseason draft, one player pivoting its entire business model, and a high-flying rookie who grew revenue by billions, but still ended up in the red.
I absolutely love this time of year. Mid-August is that critical window where public companies drop their Q2 numbers. And those numbers reveal exactly which organizations are actually building real sustainable depth for the future and which ones are just stubbornly running back the same old playbook. It literally separates the contenders from the pretenders.
So here's our starting lineup for today's Explainer. We'll kick off with the fintech offseason, check out BofA drafting for need, break down Riot's massive pivot, look at BitGo's growing pains, and finally decode the new industry playbook.
Number 1. The fintech offseason. Let's see how our trio is navigating a volatile market where the old rules just don't apply anymore.
Number 2. Bank of America drafting for need. First up on the draft board is the seasoned veteran making a multi-year capital swing that is a massive foundational shift in strategy.
Now, what's truly staggering here is the sheer shock value of this number. Bank of America just announced a $250 billion commitment. Let that sink in for a second. $250 billion. That is not just PR fluff, guys. That is a massive war chest.
They're calling this the Critical Infrastructure Finance Initiative. It's this massive lending and investing commitment squarely aimed at backing U.S. data centers, energy, and semiconductors, running all the way through July 2027. Basically, BofA is acting like a really smart general manager. They're aggressively loading up on the exact infrastructure picks everyone else is scrambling to find.
And this brilliantly illustrates their strategy. Think about it. The nation's second-largest bank, founded way back in 1904, is actively restructuring to meet the ravenous capital appetite of the AI boom. They're drafting for need. They know exactly what the market requires right now, massive energy and computing power, and they're stepping right up to be the financing backbone for the whole thing.
So the crucial point here is that BofA isn't just participating, and they certainly aren't hedging their bets. When you put $250 billion on the table for one specific theme, you are betting the house. They are boldly declaring that the AI infrastructure build-out is the undisputed future of growth for the next decade.
Number 3. Riot, a massive pivot. Let's look at a mid-career adjustment that completely changes their game.
So, if we look at Riot Platforms' Q2 2024 earnings, on paper they showed a classic beats but bleeds stat line. They actually beat revenue estimates, posting $174.2 million, which is a solid 14% year-over-year jump. But they still posted a highly painful net loss of $237 million, driven in part by $28 million in impairment charges, essentially writing down lost value. Normally, a stat line like that makes investors incredibly nervous.
But check out the stat that actually spiked their shares by a massive 22%. $9.1 billion. And this isn't from mining more Bitcoin, no. This is from a massive 20-year lease agreement with the AI company Anthropic.
Let's break down this Anthropic trade deal, because it's really fascinating. It's a 20-year lease for 191 megawatts of capacity at Riot's Rockdale, Texas campus. Combined with an existing AMD deal, this brings their total AI infrastructure up to 241 megawatts. Riot is stacking AI infrastructure contracts exactly the way a championship contender stacks two-way contracts before a playoff push. They're ensuring that a single injury, or in their case, a single Bitcoin drawdown, won't completely sink their season.
Look at this transformation. Riot spent years positioning themselves as a pure-play Bitcoin miner, which made them highly vulnerable to crypto winners. Now, they've shifted gears to become a hedged AI infrastructure provider with diversified revenue. They're joining the ranks of Mara and CleanSpark in the strategy, but Riot just landed the absolute biggest single deal in the space yet. The ultimate takeaway for Riot is that they looked at the board and found a much better, more reliable trade partner in the AI sector than Bitcoin itself. They have completely redefined their core business model, kind of right under the radar.
Number 4. BitGo rookie growing pains. Let's unpack some wild, contradictory numbers from our high-scoring rookie.
When you break down these metrics, it tells a very distinct story. You've got a company pulling in a staggering $4.3 billion in revenue, completely driven by a massive jump in digital asset trading volume. Their gross profit rose to $42.5 million.
Sounds like amazing progress, right? Well, then you look further down. Net loss was negative $19 million, and their diluted earnings per share, which is a super important profitability metric, was negative 16 cents. That is more than triple the negative 5 cents analysts were expecting. So they are crushing institutional flow, but completely whiffing on profitability and EPS.
It's exactly like a high draft pick rookie who racks up 40 points and incredible assists, but then completely chokes at the free throw line under pressure and eventually fouls out of the game. BitGo is currently living the exact same growth over margin story that Coinbase told years ago. It's just compressed into 2 highly visible quarters as a newly public company.
The takeaway from BitGo's quarter is loud and clear. The crypto-adjacent thesis is scaling incredibly fast. The top-line revenue proves that institutional adoption is absolutely real. But they desperately need more reps, more practice, and more maturity to translate those massive revenue numbers into actual bottom-line wins.
Number 5, the new playbook. What does all of this mean for the broader fintech landscape during this critical offseason?
Here's our off-season recap. We've got Bank of America, a legacy giant, heavily drafting for the AI infrastructure build-out with $250 billion. We've got Riot, who executed a massive strategic pivot to land a $9.1 billion AI lease. And we have BitGo, scoring billions in top-line points but searching for bottom-line wins. The unifying theme here is undeniable. Whether you're a 120-year-old traditional bank or a newly minted crypto custodian, surviving and thriving in this current market demands a completely new, adoptable playbook. You literally can't just run back last year's strategy.
As we wrap up this explainer, I want to leave you with a provocative thought to chew on. Look at these structural pivots and ask yourself, in your own portfolio or your own understanding of the market, are you building depth for the next decade of growth, or are you just running back yesterday's playbook? Take a hard look at the stats. And hey, if you want to keep unpacking these massive market shifts, I highly encourage you to subscribe to Fintech Stacks for more daily coverage. Thanks for joining me, and keep studying the playbook.